We did have a rocky day in the market yesterday. The Dow Jones was up and everything else was down. Now everything is down. I think that there's a lot of we really don't know what's going on with inflation still, and I know we're going to talk a lot about it. Um, I'm Rick Bell, and this is Dan Brady. We're going to talk. We're going to give talk a little bit about market conditions and what's going on over the last 3 months of the quarter. And Dan, why don't you start off?
Yeah, and we are just, don't exit too early because I know the question is on everybody's mind. What does the election mean for the market? So we're gonna get to
Oh,
that. We're gonna get to that towards the end of this. So uh just bear with us. Um so just to start with a little bit of a review of where the market is year to date, and in the second quarter. So essentially everything's up, really except for bonds. The bond trade has yet to come to fruition, which kind of makes sense just because rates have not really moved off of their highs, which we'll talk a little more about. Um, we still see U.S. large caps, leading the charge. With a bit of a surprise dark horse, emerging markets have done quite well despite a strong dollar. Um, uh, Most of these returns were actually in the first quarter, as you can see. Q2 for US large cap 4.3%, year to date up 15.3, although Rick, you just gave me an interesting factoid earlier because we're
I
looking at
did.
this end of Q2, right? So it's what, 2 weeks ago at this point?
Yep.
Um are these figures. So one thing that did come to mind, I'll let you cut in here in a second, Rick. One thing does come to mind, US small cap, and we've talked about this before, we'll talk about it again later on. US small cap, so the Russell 2000 index was up 3%, I think, on Monday or Tuesday in one day. So it
It
erased
was Tuesday. Yeah.
the whole Q2 loss was erased. So we're starting to see a little bit of a rotation, but
A little bit of a
uh
rotation, which means we're starting to come off of the top of that business cycle and start to work our way down slowly, albeit, but starting to work our way down. One that interesting factoid I gave you, that I want to share is on the first 15 days of July, marked the two best weeks stretch for the S&P 500 since 1928. So we're setting up for something. I don't know what it is, but it seems like we're setting up for maybe rolling into the election, and what the markets may do. I don't know what that is, but I just thought that was an interesting fact.
yeah, well, and quite surprising after the last 18 months that the momentum would continue at an even greater pace.
And they did
Um,
say, in that same article, actually, they were talking about, I think it was a Goldman Sachs article, talked about, don't beware of stepping in on the dips, because the dips may not stop for a little while.
mhm. Yeah. Yeah, so just a little bit about a little bit about our outlook. We'll touch on these points as we go through. We do think interest rates have peaked for this cycle, which is an important thing to define what this cycle means, and what that means moving forward. Inflation, same narrative, peaked, but what does that really mean? And is it going to end up going away? Will the trend continue? We're generally neutral in terms of our market views, although we tend to lean towards quality, which is not uncommon, but especially in times like this when you have what we'll talk about in a little bit, high valuations. In many of the U.S. large cap stocks. Um, And ultimately, on the bond side, starting to just feather out a little bit the duration. We still like the short-term CDs and treasuries where we're getting 5+%, but we're actually starting to see that some of the longer term bonds are offering more attractive rates than they had previously been, which again, we'll touch a little bit on that too. Um, in the coming slides, but going out potentially beyond, the 2 years is starting to look a little bit more attractive. Uh, so this has really been the story of the markets.
Hmm.
Not just this year. I mean, this has been a recurring theme, kind of a different way to look at it here. It was the Mag 7, and I think on one of these slides we do still refer to the Mag 7. This is breaking it down into the top five and the top 10 stocks in the S&P 500. Give just a little bit of a summary here. And you can kind of see the percentage contribution to the index's return. The top five stocks contributed 55% to the index's return year to date. The top stock, Nvidia, should be no surprise here, contributed to 28% of the S&P's return this year. The top 10 on this list contributed to 70% of the overall returns of the market. So this is not the S&P 10. This is the S&P 500. So that tells you a lot about what the remaining 490 companies did, as far as contributing to this 15%, although I believe that's up a little bit higher now after what you just mentioned with the first 2 weeks of July.
Yeah.
The 15+%, let's say, year to date return.
Let me.
Go ahead.
I was going
I
to say, let
know.
me tell you, let me just mention a little bit about what that means when investing into the S&P 500 today. So if you put $1, and I just picked this up off of a similar article in last week. If you take $1 and invest it into the S&P 500 right now, 29 cents goes to the top five stocks in that picture right there. So 30% of that dollar is going to be controlled by the top five. So if Nvidia drops, Google drops, Meta, Microsoft, Amazon drop, and they drop 10%, that's going to have just as drastic of a downside as we
Right.
had benefits of an upside over the last year.
Right.
Because the top five control a large part, 30% of the returns
Right.
at this point. Nvidia. I just remind everybody about Nvidia because there's some people that got into Nvidia and there's some people that did not get into Nvidia. And just note you may not want to follow that trend of jumping in too soon. And I'll take you all the way back to 2000 when Cisco Systems hit a peak actually of I think that peak was, and I'll tell you that peak was 72, $72 per share. That was in 2002. I'm sorry, that was in 2000. That was in actually April of 2000 when Cisco Systems hit that peak, and it dropped, never to get back up to that peak. Right now, it's at close to its high. I think the high actually was in January of 22 for Cisco Systems, was at 58. Um, and we're at 48 right now. So Cisco never came back. So not that that's going to happen to NVIDIA, but there's some more pieces to NVIDIA that people don't realize is their top two revenue generators are actually Microsoft and Meta, the other two in that top five, and both of them they're working on making their own chips. And if either one of those come in, 15% of Nvidia's revenue comes from Microsoft, and I think it was 13%. 13%, yeah, 13% comes from Meta, and then also Amazon and Google play a role in that as well, much smaller, but still play a role in that. But yeah, that anything that happens with NVIDIA can take out a decent part of that and make everything else drop on the S&P 500. So we don't know what's going to cause it or how long it's going to continue to go, but it's just going to be interesting moving forward.
Right. Yeah. Yeah, and I think it's also important to note that this is essentially a vote of the market to say, you know, we see the future of AI, and there's a lot of hype, but more importantly, a lot of a lot of assumed growth here. So far, NVIDIA has beat most of their earnings estimates, which is what you want to see from that trade, so to speak.
Yeah.
But, again, whether or not that can continue, most of this is if they meet their estimates, we're not going to see much in moves in the price share. And the estimates right now in terms of earnings are quite high, and
Hmm.
you're seeing that in multiples. So we brought this up last quarter. Again, this one's using the Mag 7, so the top seven stocks, which if we go back here, NVIDIA, Microsoft, Alphabet, Meta, Amazon, and Apple are the top seven. Um, that's what
Amazon
this.
and Lilly.
Yeah, no, sorry. I'm looking at portfolio weight. Lilly contributed more to the index return, probably because of weight loss drugs, but they're still not as large as Apple.
Gotcha.
So anyway, those top seven, when you take a look at the PE ratios, price earnings, 30 times 30 times earnings those companies are trading at. They are profitable. This is not a 2000s tech bubble, right? Where
Hmm.
we're trading on pure speculation. These are profitable companies, but the multiples, make no mistake about it, are high. And all you have to do is pull those top seven out from the rest of the index, and their multiples are over 50% higher than the rest of the index. What we believe that this means is it does not mean that they're not worth it. It does not mean that the AI trade is over. It does, it's probably just beginning, but it means that there can be disruption. And probably more importantly and broadly, it means that very likely that should we continue to see growth, both in the economy and equity markets, that will likely broaden out. And we started to see that a little bit earlier this week with small cap stocks rallying 3%, weirdly on the same day that the Dow rallied. So when else do you see the Dow Jones and small caps put in the same boat? Like it just doesn't make sense that they're rallying at the same time, right? The stodgy Dow Jones Industrial Index versus the unprofitable Russell 2000. They don't mix, yet their kind of movements recently are very similar, and most of that is due to market concentration. So you're seeing those performance, that performance broaden out to other asset classes. Um, has not fully come to fruition yet, but we expect that to continue. Um, Let me move. Before we move off of that, anything else you wanted to chime in on there, Rick, before we move to the whole inflation stuff?
Nope, other than the fact that we need we need the rest of the S&P to broaden out a little bit because
Yeah.
if we do have a falter in the top five or top seven
Yeah.
stocks, we need something else to be able to catch that, and that S&P broadening out more would be um, extraordinarily beneficial. But
Sure. Sure.
this is what you see in indexes. So indexes tend to go up more aggressively than managed accounts.
Well,
Managed
especially
account,
especially the cap weighted one, especially like the S&P.
absolutely, yeah.
Yeah. Um, so in any event, that's what's happening under the hood. Um, we're going to pivot a little bit here to a little bit of economic chatter, I suppose. Um, so inflation, we see a lot about inflation, and we pay attention to it a lot because, this has uh, a lot of implications for portfolios, both on our continued focus on quality, in stock investments and dividends, as well as bond portfolios. This gives you a look at the consumer price index. I call it the headline inflation, which is the blue line, and the orange line, which is the headline inflation number, and specifically excluding the shelter component of inflation. The shelter component of inflation is essentially housing. And yes, housing does reflect both rent as well as the cost of homes.
Single families, yeah.
So, and that is a little more than a third. It's 36%, I believe, to be somewhat exact. 36% of the index. So, of inflation. So, there are times, this goes back historically, and you can see at times where when you strip out the shelter component, the housing costs, that the orange line is significantly less than the blue line, which is where we are today. Not always, but this does happen. What this basically means is whenever the orange line is significantly less than the blue line, is that housing is contributing a very large amount towards headline inflation. That's basically what that means. The inflation in home prices, the inflation in rent is contributing towards the headline inflation at a great degree. And today, headline inflation, I believe, is 3.3%. We're going to talk about that.
Yep.
When you take housing out of it, you're at closer to the Fed's target of 2%. So, ultimately, this is an important thing to realize, because essentially, you can look at this and say, well, if we expect inflation to cool, that means we're going to expect housing costs to kind of level off or subside a little bit. Would not be a bad assumption. So you can see when you take X shelter, when you take shelter out, so mid 2022, and you take a look at the 20-year average versus what happened after 2022. So CPIX shelter has increased 1.75% annualized over the last 12 months. And we know that the Fed's target is 2. So take out that large increase, 2020 through 2022, and ultimately the CPI, when you take out the shelter component, looks pretty good, pretty much in line with where the Fed wants it to be. They just can't seem to get the housing component under control.
Yeah, so to touch on that housing starts came out yesterday. And Dan, you talked about how the shelter component being 36%.
Right.
The primary residence is 26% of that 36%. Okay,
Right.
so
Right.
primary residence are your single family homes. But in that number, the single family housing has actually fallen 2.2%. And the apartments or multifamily housing has increased by 22%. So the housing piece to this component is slowing down a bit, but we still have a lot of people out there that technically want houses and can't buy houses at this point. I think we're still to this date about 4 million houses short, if I remember correctly.
Well, and that's why you see multifamily going more aggressively.
Yep.
And this is just a suspicion, but my guess is the reason you're seeing the single families level off and maybe even decrease a bit is a lot of buyers are waiting with bated breath for Jerome Powell to say we're going to start reducing interest rates. And the concern is what happens when that's the case, because there's still an awful lot of demand out there,
Yes. And if
right?
interest
So,
rates start to drop a little bit, it may not affect it instantaneously, but if they
right,
keep dropping, which I think PNC came out, by the end of the year, it'll be down to 4.6%, I think, for Fed
right,
funds.
right,
That's a
yeah,
couple of drops. So it'll
three,
be
yeah,
interesting. Yep.
yeah, three drops. So I think, I mean, to tie in this inflation piece, what's interesting to me is where you can really see sort of the issue here of, or I should say, why the cost of housing is such a big issue. Um, to go back, this is kind of a busy chart. Really, let's break it down into the orange is the core CPI. So core meaning essentially the non-transient part of inflation, the type of inflation that tends to stick around. Um, the target rate is that little gray dotted line. We go back to the peak 9.1% in 2022. We kept hearing that word transient, and ultimately the reason for that word was, if you take a look at the orange line and what was above it, goods, food, and energy, right? So energy price inflation, food inflation, goods inflation, all of those. And, to their credit, true to their word, the Fed was right, as those were transient. And the increase in rates did, in fact, reduce that overall inflation related to those categories. But if you go back and you draw a line from that orange bar, where we are right now in the core CPI, 3.4%, 3.4% was the same as what it was in 2022. And I mean, this just goes to show how difficult it is to get rid of the core inflation. Now, even though we're seeing some encouraging numbers in shelter, which, as I mentioned, shelter is really the reason that this remains elevated. Um, it's not necessarily an easy task to get that from. It's easier to go from 9.1 to 3.3 than from 3.3 down to 2, which is where the Fed wants it. Uh, when all of the inflation left is considered, core, which is what we see today. So in order for that to happen, housing is uh, uh, it can be volatile, right? But not like food and energy from an inflation standpoint. So this is likely a longer term problem, even though we do expect the inflation to cool. The question is, what happens when rates come down? Does that inflation come right back? And I think there's a good chance of that. One other, just sort of just for what it's worth, it might be surprising to see this chart and you say, well, what do you mean food inflation isn't gone or energy inflation is gone? Things cost way more than they did. And this is important because we don't have it in this slide deck, but consumer sentiment is actually way down. And one of the main reasons for that in the polls was that consumers are worried about inflation and see a lot of inflation, not because everybody's buying homes left and right, but because most consumers, when they look at inflation, they're thinking about, what did this loaf of bread cost me 2 years ago versus today, right? So even though we're not seeing inflation month over month or year over year at this point in time, we tend to just compare what our grocery bill is or what we're paying at the pump versus a year ago, 2 years ago. And that's not changing. That hasn't gone back. So we're not seeing any disinflation. We're not seeing any, subsequent inflation in addition to what we've gotten, but consumers are still looking at this as a problem. And I think they're right. It's just, that in order to fix the problem, it's going to take a much longer dedicated effort towards keeping rates higher for longer. And
Yeah,
we're
I
going to
mean,
talk about that a little bit in the next slide here.
yeah, what they still feel is what comes out of their pockets is food and energy technically.
Right. Yeah.
And going out, I mean, you look at the services, even going out to meals has increased quite a bit as well,
Sure. Yeah.
in costs.
Right.
So it's going to be, that trying to get that down. Once that goes up, especially food, once food goes up, it doesn't come back down
Food.
easily.
Right. Right.
It's very sticky inflation.
So, um, so ultimately, what that means for monetary policy, I'm going to try to make this as simple as I can, but we're looking at two things here. We're looking at the Treasury yield curve in the green line, which essentially is saying, what is the difference between a 10-year Treasury and a 1-year Treasury? When it's above zero, that means you get a higher interest rate on a 10-year than a 1-year. When it's below zero, it's the opposite, which is where we've been, since 2022 at this point. Everybody, I think this is common knowledge at this point because it's been so long that this has been the case right now. You can get more, on a 1-year CD or an 18-month CD than you can get on a 5 or 10-year CD. That has been the case for quite some time that
A little over two
we've
years.
right. We've talked about it as a recession sort of maybe not predictor, but indicator. And really the reason it's an indicator of recession is because it means that it assumes rates are going down. Why do you need to bring rates down? To stifle growth. Probably it's a better predictor of where rates are going, meaning they're likely to go up or down. However, one thing that we hadn't seen yet, and we are just now seeing, which is the blue line, is the current benchmark interest rate set by the Federal Reserve. When you adjust it for inflation, what's the quote real rate? So one of the reasons we saw, such a home buying frenzy back in, um, really, since COVID, as of course, COVID could have been part of that, but just from a cost of capital standpoint, the real rate was negative, meaning that the interest rate was less than the rate of inflation, which seems almost just nonsensical when inflation was near zero, but rates somehow were even cheaper. And then as inflation went up, the Fed was behind the 8 ball and rates were still very low. Now we've seen the opposite. So you see the large jump up in the real federal funds rate, and it's remaining at that level. Typically, this should be positive. But what you see is a crossover here. There's a crossover that happened in these lines, and one went above zero, one went below zero. And typically when this happens, it's prior to recessions, although there really is no rhyme or reason as to how long that takes. And I'm just going to go back to a a scenario that we could certainly see playing out. We've talked about the 70s a lot, but I'm going to talk about the 90s. There's a crossover event right here. Same thing. The blue line jumps up, the green line goes down. And then what happens?
Not a recession.
A recession takes another 8 years to happen. But I think what's more important to understand is rates remain elevated and the yield curve remains flat, right? Meaning you don't see all of a sudden on a 30-year bond, you're getting, 7%, when on a 1-year CD, you're getting 5%. It remains fairly flat. There's gyrations, right? You can see rates come down, they remain, they go back up again, they come down. We think that this is actually much more likely of a scenario because we'll talk about it in the next slide. The consumer looks healthy, the economy looks healthy. So there's really no impetus for a recession at this point until something knocks us off course. But I think importantly, with the backdrop of housing and core inflation being very stubborn, the Fed is likely going to cut rates. That seems like a foregone conclusion. But if you look over the next year or two or three, I'm struggling to see a reason for the Fed to keep cutting rates. And I
Yep.
think we are likely in a scenario where rates will remain elevated. And we're starting to see 5, 10, 20-year bonds, the yields are moving up, which basically gives you an indication that the bond market thinks rates are going to remain higher. And that would make sense if inflation does, in fact, core inflation does remain elevated and it remains difficult for inflation to completely get back to 2%, it would make sense that the Fed starts to kind of tinker with things, right? Push on the gas a little bit by lowering rates, but ultimately, we're going pretty fast already, so they can push on it a little more, but they're probably going to have to ease off and raise rates back a bit again. So, for
Or
those people waiting for mortgage rates to go back to 3%, I don't think it's going to happen.
yeah, no way.
So that's the interesting piece of this is that, I think it's very possible that we remain in a similar environment for quite some time until whatever the thing is in the 90s, it was the tech bubble, but whatever the thing is that knocks us off course, it's very possible we remain in a similar monetary policy landscape for the foreseeable future.
And your thought process on that flat yield curve, basically, if Fed does reduce interest rates a little bit on the front end, you and I talked a couple of times in the past quarterly conversations about the steepening of the yield curve,
Yeah.
and longer rates going up. We don't think longer rates are going to go up a lot, but one of the
No.
things that I just read recently was the federal government issues treasuries on a weekly basis, and basically, what's happening if there's no buyers in the market, obviously the interest rates will go up. They've been issuing treasuries in the front end of on the front end of that yield curve for the last quite a few years. They're pushing to start issuing treasuries out on the longer end of the yield curve. So once they start, as one piece of making that interest rates go up, once they start issuing treasuries on the longer end of the yield curve, that'll push rates up on that 10 to 30-year rate level as well, which
Right,
actually
right, right,
would
right,
make that cause that steepening to go up a little bit more. The front end of the rates come down, and now you got a completely flat yield curve,
right.
which we could sit there for quite a while,
Yeah, yeah,
as you said.
yeah, right, exactly. I agree, and I think that's where we're heading. And here's one of the reasons we say that is the economy does look strong, but one thing to keep in mind, and one of the reasons the Fed, and look, the Fed looks at all of this stuff and they see a strong economy. But what they're starting to see is the consumer, right? Debt service remains low, right? So ultimately, even though rates have increased, we're not seeing an irresponsible level of debt or debt payments at this point in time. In fact, this is interesting. Nearly half of all mortgages outstanding have a fixed rate below 4%.
That's
So
a stat I did not know.
yeah, so that is interesting, and it certainly helps the long-term outlook for the economy. One thing that is, I don't want to say this is concerning, but we're sort of back to our base scenario. The excess, all that mountain of cash that was pushed in during the pandemic and ultimately ended up just creating inflation both in markets and asset prices and ultimately as well as eventually it bled its way back into the consumer price index. That is gone. That is gone. So the excess savings as of April, so as of this past quarter, has actually gone negative. I don't know the exact metric for how they calculate this, but this is pandemic excess savings. So that has gone negative, meaning all of the excess from the pandemic has
That's been
filtered its
spent.
has filtered its way into wherever it was going to go and ultimately did go. So we're kind of finally out of that mess, if you will, from a sort of artificial cash standpoint. That is all gone. So now, how much of the economic growth driven by the consumer was due to that cash? Because as you can see, that cash was being spent. Now, some of it was invested, some of it was buying houses. I'm not saying that it was just spent on something frivolous, but it was driving the economy in some way, shape, or form. So, now that that is gone, it'll be interesting to see what happens next. Luckily, employment is labor market's still very strong. Unemployment is low. We're still seeing wage growth, so there's still a driver. But I think this is important to realize that, and I want to say we're starting to see some cracks, but that extra fuel that the consumer had is no longer there.
Yeah, LPL put out some
Oh,
research the other day on that. Actually, it wasn't the other day, it was back in May. It says when households exhaust their accumulated savings, it could lead to a decline in discretionary spending. And that
yeah,
discretionary
yeah, yeah.
spending
Oh, sure, yeah,
is not food like we were talking about, but more of the services part of the index or services part of the CPI. So which could potentially pull that down. But it also came back and said exactly what you're saying here is the healthy household balance sheet supports a low mortgage debt service, which could help offset that reduction or depletion in savings
right,
because
right,
there is more cash available because over half the households have interest rates lower than 4%.
right, right. So, I mean, ultimately, to kind of tie a bow on this, we do see, um, we do see rate cuts. We do think inflation will continue cooling, but I don't think, I think that there's a penchant for investors to sort of look at this and say we want to get back to the way things were, and I think that there is a good case to be made that a
We're
couple
not.
of the main sort of assumptions about investing, over the last whatever 2 decades of cheap capital and low inflation and all that kind of stuff. I think there's a good case to be made that that's not going to be the next. Now, look, I'm not making a prediction for the next 3 months or the next year, but I think that there's a good case to be made that that's not going to be the next market cycle, that the cost is going to remain higher, that it's going to be very difficult to get inflation reliably down to 2% for long periods of time. And I think the Fed does a difficult job in trying to navigate that. So, and there's bound to be mistakes in their policy. This is more of an art than a science. There's a lot of data points here, but ultimately, this is all economic theory. So they're trying to get it right, but they can
And
make
they just may.
mistakes, right?
They just may get it right with that business cycle. That business cycle,
Yeah,
and it may not take such a deep
sure.
and long um, downside or trough. It might be
Well,
just
yeah.
a little downhill and then back up again.
Well, let's
Especially
hope
where
so.
yeah, especially where AI comes in,
Right,
and we might be in those beginning stages of how AI is going to affect or be the engine of the market, and
right,
ultimately could be the engine of the economy, as computers and internet was to the economy back in the 90s and then
right,
2000s.
right. Yep. So, all right, let's get to the what everybody wants to talk about.
Election.
Yeah, we're not going to talk politics. Well, we'll talk political parties, but we're going to specifically talk about how the market reacts, and we have a couple slides here that I think will be interesting. Um, so this one is going back to the 20s. So this is actually using the Dow. So all of these really long terms use the Dow, showing the average return, right, which is in that little gray at the bottom where it's circled. You can see that red circle. Average return of the market in an election year is 7.5%. And then you can see typically the best year is the year before the election, average return of close to 14%. We don't know what the market's going to finish the year at. Last year we did have a great year, so this is probably going to hold true that last year, the year before the election year, was the best out of the four. Typically, the worst year is 2 years after the election year. Average of only a 3.3% return and only up about half the time. Right. So think about like, I guess, coming out of right after midterms is typically the worst year. Percentage of time stocks rose, again, typically best the year before of the election and the year of the election. Over 3/4 of the time in both cases, the market is up. So looking for any correlation just in terms of election cycle, this is it. And thus far the trend is remaining true. I think it is interesting to say, to look at this. If you look at it from an election cycle, at all times, it's always more than 50%, no matter what year you're in. Right? The market's typically up over half the time, no matter what year of the election cycle you're in. So just for what it's worth.
And I think there's statistics out there that talks about the market's up 60% of the time anyway.
Sure, right.
So,
Which putting it through the lens of the election cycle doesn't change that.
yeah, it's the year of the election and the year before the election that really matter.
Right. So this is showing those actual years, the markets, each presidential election year going back to 1928, who won, Republican, Democrat, and what the returns were for the index in that given year. So you see there were only 4 years total where the market was down in that election year. 4 total over these, however many we have on the screen here. So I think that this is an interesting slide to just put it into perspective. Ultimately, it typically does not matter, who wins party-wise as far as what the market does. I did have a couple of points to share here. I want to bring this up. So I was recently in a session with a part of Schwab's political team. They have a team of 10 folks that are down on the Hill, and they do research with how politics affects markets, and they're actually down there, sort of getting the inside scoop. But there was a couple of things in particular that we thought were interesting. So, and I'm gonna start off here, and I'll go down the list. So, the market has risen in 13 consecutive election years when the incumbent was running for re-election. So anytime there's been an incumbent for the last 13 consecutive elections, the market was up. They were unable to find any pattern, any correlations for how the market reacts after an election. And they look at this through the lens of, well, what if it's a Republican? What if it's a Democrat? No pattern there, as well as no real pattern as to like which sector may benefit or may not benefit based on it being an election year. However, they did find, and this is what I thought was interesting, is we're always asked, well, what happens if Trump wins? What happens if Biden wins? Or what happens if, the Republicans take control of the Senate, or Democrats? We get asked that all the time. And what does that mean for the market? And ultimately, you really don't know. And we're going to talk about this a little bit. There are some correlations with parties and who controls which, Senate, House. There's a much greater correlation between what happens in the market and what it means for the election, which kind of makes sense because, right, the market is sort of somewhat of a predictor of where things are going. So I'll give you 2 stats here that are pretty compelling. So if there's been a recession in the previous 2 years, which right now, 2024, we're not in that camp. But if there's been a recession in the previous 2 years, The incumbent has lost all 6 times that has happened. So a recent recession is um, almost always a you're out of here for the incumbent, which makes sense. The other one, which I thought was interesting, is there's a very strong correlation. 20 of the last 24 elections, the performance of the S&P 500 in the last 3 months before the election. So I think we were talking, that'd be like, whatever, uh, mid-August to mid-November, something like that, right? Whatever the market does, that has predicted 20 of the last 24 elections. So to put that a different way, let's say the market was up during that time frame, it would suggest that Biden's going to win because he's the incumbent. If the market is down during that time frame, it would suggest that Trump's going to win because he's the challenger. Not perfect, 20 of the last 24 election, but it was actually the most significant statistical correlation that they found between anything relating to market performance and elections. It was, how does the market do 3 months leading up to the election, and what does it say about who wins? So I thought that was interesting.
Yeah, so depending on whose side you are on, and the your hope could be that the market goes up, or your hope can be that the market drops off. We do anticipate that, our anticipation from the beginning of the year, if I remember correctly, Dan, was we believe the market will be up this year, but we believe it'll be up in the single digits. Um, if that theory plays out, where are we right now? Up 18%
Right.
on the S&P. But anyway, that's there. These are interesting statistics. I think you have some more coming up on the next slide too, which I thought
Yeah.
were quite interesting here as well.
Yeah. I mean, this one, again, this is more, I guess, for what it's worth. This is not like there's a huge correlation um, between any of these. However, looking at the numbers, this is showing you essentially um, split Congress, right? Unified Congress and unified government. Uh, Typically, if we're looking at what is the best scenario for markets, and we've said this before in the past, typically and we're going to continue on the same trend of don't think about your political party or affiliation when investing. Typically, the market likes when there's a split, right? So unified government tends to be the least favorable outcome, just in total. So in other words, if you are a Trump voter and you say, well, if there's a Republican president, I also want the Republicans to take over the Senate and the House. I want just a complete red wave. Okay, well then, historically returns would be 12.9%. From a market standpoint, again, historically, it would actually be better if you go over to the left-hand side. If Congress was split and you had a Republican president and then the Democrats controlled the House, the market is typically up 13.7%. Same thing if you're a Biden voter and you say, well, I just want a complete blue wave. President, Senate, House, everything is Democrat. 9% typically is the return numbers. Well, go over to the left-hand side, split Congress, that goes up to 15.7%. So, typically, the market likes to see partisan control one way or another, or I'm sorry, bipartisan control one way or another. It's again, this is not a perfect correlation, but generally speaking, over the long periods of time, usually the market is performing better during times of divided government.
Which is the way it's supposed to be.
Yeah, well, and somebody put it this way, this isn't mine, but somebody said, well, that's just because they can't hurt you too much if they don't all control everything, right? Which, there may or may not be some truth to that, but it's true that typically the market is up more when there is a divided government. One interesting stat is currently the Senate favors Republicans and the House favors Democrats. And the House and the Senate have never flipped in opposite directions in the same election. But they're I don't want to say they're predicting it, but it could happen this year. Never happened before. So again, not sure what that means for the markets, but just an interesting factoid. Probably good because the market likes divided government. Um,
You've
one
come up
other
with a lot of
thing.
interesting factoids
Yeah, well,
today.
it's not mine, but I have it. So here's really the bottom line and why we bring up all of these kind of different charts here is going back, and this is 61, so I think the last 12 presidents. And we have another chart. It's not in this slide deck, but if you were to only invest if a Republican was in office, or if you were to only invest if a Democrat was in office, uh, not a good investment thesis. Ultimately, the market grows over time. It does not matter who's in office. In fact, you can see whether it's red or blue, or red and then blue. There's periods of growth. There's periods of downturns, stagnation. There doesn't really seem to be any correlation between one or the other. And in fact, if you did only invest during one or the other, you would be much worse off than if you were to just stay invested regardless of who's in office. And at the end of the day, that's really the point that we're trying to make is who wins the election, whether it's an election year or not an election year. What matters more is what's happening in the economy, what's the Fed doing with interest rates, is inflation going away, is corporate America meeting its earnings targets, things of that nature, the things we typically talk about on these quarterly meetings, and really just sort of ignoring the political landscape as any means of an investment thesis. So with that, I think that's a perfect place to sort of pause here. And Rick, I don't know if you had anything else you wanted to talk about, but if anybody has questions, feel free to pop them in the chat box or the Q&A box, and we can
Yeah.
hang around for a bit.
Yeah, that last chart you brought up is an interesting chart because the bottom line is, and I think when we discussed the last quarterly conversations is when you brought up the chart of who whoever wins an election, what the market does, I think is what that chart was that you were talking about. Who votes, who invests in the market if the Democrats win, who invests in the market when the Republicans win. I think we
Right.
brought that up in the last quarterly conversations.
I think we did,
Um,
yeah.
but the bottom line is the key is staying fully invested. And we typically will stay fully invested. Interest rates being where they are today, fully invested in the bond side of the market is going to mean short-term treasuries at the most part, and being invested in short-term bond funds, short-term treasuries, things like that, and also staying focused on value. If we do go into a recession, if things fall apart, value investing tends to hold up on their in recessionary times,
Right.
better than growth stocks, obviously. So having a good position of the value keeps us well allocated as we are. There was something else I wanted to say. I can't remember. I don't see. Do you see questions coming up? Any thoughts?
No, I think we can wrap it up, and everybody can go enjoy the rest of their summer.
All right, Dan, appreciate you taking and putting that together. Dan, as you know, writes the quarterly market letter, and he pulls these slides together. My favorite thing to do is read the articles and how they apply to everything that Dan talks about. Um, so my, it's a fun quarterly conversation. We enjoy doing it. We enjoy putting it together, and we appreciate everybody participating.
Yeah. Thank you, everybody. And we'll talk to you next quarter, if not
Have a great
sooner.
summer.